My name is Jonathan Alexander. Um, Finance 451. This is my investment analysis. Two industries I chose to do my project on, analysis on, is retail and healthcare. For retail, Best Buy, Target, Conn's, H Gregg, Bed Bath and Beyond. For healthcare, I had Humana, United Health Group, Aetna, Cigna, and CVS Health. As I was analyzing these companies, I chose to harp on these few things: the cash ratio, current ratio, quick ratio, leverage, profit margin, return on assets, and return on equity. All right, so first we're going to talk about the cash ratio. Um, Cash ratio, quick ratio, current ratio, they all measure a company's liquidity. You really can't base it on just strictly on one of the three ratios, because like Dr. Cresson said, you like all three, they all tell a story. So for cash ratio, I have retail at the top and healthcare at the bottom. So for our cash ratios, basically, the cash is obviously a current asset, but what you're doing is you're taking the cash, you're taking the cash equivalents and investment funds out of the current assets, and you're putting that up against current liabilities. So you want that to cover your current liabilities in the cash ratio. So there's a 5-year period from 2010 to 2014. I don't have it on here, but in Excel, I took the averages, and it kind of gave me a better idea of where each company stands. I know that's not the way to do it, but just help me understand it and get through it just a little bit more. But basically, for retail, Bed Bath and Beyond, is clear as day, is more liquid. They started off strong with 1.3288 in 2010, increased in 2011, and then dropped a little bit in 2012. But from 2012 to 2013, they dropped drastically. So I'm guessing, or I'm assuming that either they must have had less cash and less cash equivalents, or more current liabilities. So basically, it wasn't able, the cash and current and cash equivalents basically wasn't able to cover the current liabilities. And the same thing with 2014, except in 2014 they dropped even more. But the crazy part is, when comparing and contrasting Bed Bath and Beyond to the four other companies, it still excelled in every year compared to the other companies. No matter if it went high or if it dropped, it still excelled over every other company. Same thing for Humana. Same thing. They're basically in the same boat as Bed Bath and Beyond almost, except they didn't drop under one. 2010 they started off strong at 1.4876, increased in 2011, dropped a little bit in 2012, barely in 2013, dropped a little bit in 2014, but they still had enough cash to cover their current liabilities. Like I said, same thing happened for Humana from 2010 to 2014. Very lopsided, very lopsided compared to the other four companies. All right, our current ratio. Basically, with current ratios, um, current assets over current liabilities. So I can tell you, current assets over current liabilities. You want your assets to cover your liabilities. You like current ratios. You want them to be high. You want them to be over one, but you don't want them too high. In retail, I like Cons and I like Bed Bath and Beyond. Um, I'm gonna explain why I like Bed Bath and Beyond more than I like Cons further along the line, but I kind of chose Bed Bath and Beyond once I grabbed the averages. from 2010 to 2014, and I kind of compared and contrast the averages of them all because it looks like cons is good, but then once I grabbed the averages, I kind of pulled back to Bed Bath and Beyond, and you want current assets to cover your liabilities, but you don't want that to determine the company's liquidity. With that being said, Cons has a high current ratio, but that is what makes it illiquid, and it would not be able to operate under certain conditions because they have a lot of assets, but they have very little cash generation. As you saw, let's go back. As you saw in our cash ratio, very little cash generation. Great for current assets in the current ratio, but not great when it comes to cash. Very little generation there. And that's part of the reason why you can't base a certain ratio just off of one finding, basically, because you like all three and they all tell a story, and I'm getting to that story. But so once I grabbed the averages, I like Bed Bath and Beyond, and I liked it more than the rest of them. I know everything else is over one, but at the same time, when I was going back, cash ratios, that's what it fell under, cash ratio. They don't have a lot of cash generation, whereas Bed Bath and Beyond totally blew the other four companies out of the water when it came to the cash ratio for cash generation. Humana is pretty stable and moderate. So is CVS, but the only thing I didn't like about CVS is they have very little cash generation as well. They are net liquid in the cash ratio. They're pretty okay in the current ratio, as you can see. But I chose Humana for the most part because they're over one. They're not too high. They're kind of at where they're basically at two. Over one, at two. That's a win-win for me for Humana. Only thing about CVS, I'm gonna get into that once I talk about the quick ratio, which is why I don't prefer them for current ratio. Let's see. All right. For our quick ratio, okay. We like quick ratio because it takes away the inventory and focuses on the liquid assets of the company. For our quick ratio, there's a significant difference between the current ratio and the quick ratio, but they don't rely on inventory, as is also the best company in retail, which is Bed Bath and Beyond, when it comes to the cash ratio when paying back. So when they have to pay people back, like I said, that's why I chose Bed Bath and Beyond in the long run, because they're good at paying people back. They don't focus on inventory as much. They're very liquid with cash. That's 3 across the board for Bed Bath and Beyond. Con. Whenever I compared and contrast cons in my Excel format, it dropped drastically from the quick ratio and the current ratio. Let me see if I can go back. Going back and forth, they dropped drastically, and at the same time, it's great that they have more current assets than liabilities, but they don't have a lot of cash generation, and for the most part, inventory as well. Humana, same thing for Humana, all the way across the board. When it comes to quick cash and current, they're actually in the same boat as Bed Bath and Beyond. They don't rely heavily on inventory. More current assets than current liabilities is high, but not too high, and then they have a lot of cash generation as well, as opposed to the other four. That is why I didn't pay much attention to CVS when it came to the current ratio. And so I didn't have this in mind, but when I was choosing these companies, I didn't expect all three companies to actually excel in every ratio when it comes all together, because you can't base one company based upon one ratio because, like you said, you like all three basically, and they all tell a story. And that's the story Bed Bath and Beyond and Humana told. And later on down the line, I'm explain why I like them as the best company because they're hands down the best company in each industry. Okay, we're gonna talk about leverage. With these numbers, we're measuring the debt load. We want the company with the least debt because they will have less debt relative to the assets. So these companies will have less of a burden of the interest, less of a burden because interest won't take a large amount of the company's cash flows. You don't want too much leverage. Leverage is good. Like Dr. Cresson said, leverage magnifies gains and losses. The financial performance and interest rates could result in default if you have too much leverage. This makes a company not sensitive to changes when it comes to making executive decisions and in interest rates as well. So we want low leverage but not too low. We want high leverage but not too high. Because if we have too low of leverage, lenders and investors know that their interests aren't protected if a company were to fall under or go into a decline. So you want to have enough leverage to be protected for the most part. So for leverage, shareholders will receive some of their investment back in liquidation. So for leverage, like I said, I went across the board. Best Buy, for the most part, too high. It's pretty good, too high though. That's the only thing. Like I said, what excelled again in retail was Bed Bath and Beyond. Leverage is high. It's over one. It's not too high and it's not too low. As you can see from 2010 to 2014, it stayed at a pretty moderate pace. Even though it increased, it stayed at a moderate pace. So it wasn't a lot of jumps. As you can see, if you're looking at the other four companies in the retail industry, you see a lot of spikes, up and down spikes in each year, from year to year when it comes to leverage. So they're taking some risks. They're taking some big hits there. They have some losses and they have some gains, especially looking at these numbers because the spikes are crazy as opposed to Bed Bath and Beyond overall. For healthcare, at this point in time, I like CVS. I like Humana as well. I actually like both of them. I have them both written down. For the most part, CVS is real good. Same boat as Bed Bath and Beyond, not Best Buy, but Bed Bath and Beyond. Humana is over two. I feel like they're not too high, but I feel like they're pretty moderate because they're right above two. As opposed to the other companies, they're kind of doing the same thing. They're not spiking as retail does because I know the retail business is more riskier. You take bigger risks as opposed to healthcare. When it comes to leverage, you kind of want to stay in the same area, healthcare as to retail, because in retail you can never really estimate. So I guess I can understand the spikes. I guess for the bigger companies, let me put it like that, for the bigger companies when it comes to leverage. So the profit margin. In our profit margin, what we're doing is we're taking the net income and dividing it by sales. Basically, these numbers are percentage numbers on how much out of every dollar of sales the company is keeping in earnings, basically. So, for example, we're just going to say Target. In 2010. So their profit margin was at 3.8%. So for basically for every dollar they got three cents basically. Well, basically 4 cents if you round it up. Basically for every dollar in earnings they got about 4 cents. Um, but you basically want the biggest profit margin because that's basically what you want the biggest profit margin. It's profit margin for a reason. It's whichever company can get the biggest profit when it comes to earnings for per dollar. Let's put it like that. And across the board in retail, yet again, Bed Bath and Beyond, 2010, they went from about 7 cents per dollar in earnings. In 2011, 9 cents. 2012, 10 cents. They dropped to 9 cents, 8 cents. But as you can see, compared to the other companies, again, in the retail industry that I chose, it is very, very lopsided. As opposed to, let's take it from, if we're ranging it from greatest to the smallest, if we go to Conn's, Conn's barely averaged a cent per dollar in 2010. They actually went in the negatives from 2011 to 2012, but yet again you see a big spike in their profit margin from 12 to 13, and they start increasing up to 14. So if I had to guess, I would assume that they would keep increasing in their profit margin. Going down to healthcare, Cigna did pretty well in that profit margin area. I'm always stuck on Humana. I'm gonna keep talking about Humana because it's just something about them that I really, really like. When I was analyzing the cash ratios, and that's what kind of got me more and more attracted to them. But Cigna, for the most part, from 2010 2014, had the biggest profit margin when it came to comparing and contrasting the companies. Like I said, just looking at it, you can kind of tell, but me just taking averages basically and comparing and contrasting, which kind of gave me a better idea. So we're going to talk about return on assets. Basically, for return on assets, you want to see how profitable a company is relative to the total assets. So gives an idea of how efficient management is using its assets to generate earnings, basically, because for ROA is what net income over total assets. So it's telling us what earnings were generated from investment capital. So assets of a company are based upon equity and debt. ROA. So ROA gives us the company some sort of idea of how they're converting their money, I guess, and how they're going to invest it into net income. So long story short, you basically want to make large profits off of as little investment as possible, not the other way around. So it's all about what company is better at converting this investment into the biggest profit by using as little investment as possible, if that makes sense. And going up into the retail, we like H.H. Gregg and Bed Bath and Beyond, but we love Bed Bath and Beyond. H.H. Gregg did well, started off strong between the two, increased, but then dropped drastically in their assets in 2011 and continued to drop in 2014. So I'm guessing that more assets or less income. If I had to guess, it'd be less net income for the most part. But Bed Bath and Beyond is steadily increasing up until 2014. Well, it dropped a little bit on assets, but dropping down to healthcare. We love Humana. Yet again, we like CVS, United Health Group. We actually like them all because they're all getting some type of return. Well, let's put it like this: a positive return, um, as opposed to retail where we had some negative ROAs for the year, as opposed to healthcare. Because I know retail and healthcare are two different industries. They work in two totally different ways. But yet again, um, I grabbed the averages from healthcare and retail, and Humana and United Health obviously pretty good when it comes to ROA and determining what's best for the company by taking their investment capital and making as much of a profit as possible. Same thing for CVS. They kind of started off low, but they steady increased over the years after 2011. Let's go on to return on equity. So basically, for return on equity, we have the net income, the amount of net income being returned back to the shareholders as a percentage. So it's how much equity our shareholders are getting back at the end of the year. And you're measuring the company's profitability by revealing how much of a profit the company is actually making with the shareholders' money that's actually being invested into the company. So how much being invested, and how much equity is going to actually be returned to them varies. So, sorry, I just kind of went brain dead. So when it comes to retail, return on equity, yet again, we like Bed Bath & Beyond, we like Target. Best Buy and H.H. Gregg and Conn's started off well, but then they went on the decline when it came to the returning on the equity part. I have to find out what happened there. Either they must not made enough net income to get enough return back to the shareholders, but again, Bed Bath & Beyond is yet again kind of lopsided in the game. H.H. Gregg was doing fine, but they spiked in their ROE. Bed Bath & Beyond, yet again, we're seeing an increase in return on equity, and you're kind of wondering, doing all this research on Bed Bath & Beyond, if we should start investing in that stock. I don't know, you never know, but like I said, this is just Bed Bath & Beyond compared to 4 other companies though. I have to see compared to, if you compare it to the S&P 500, but so far for this project, Bed Bath & Beyond for retail kind of had like a clear shot. Like it was never any competition when it came to analyzing for the most part. For healthcare, we like Cigna, and for the most part, they started off strong, but they decreased. Aetna and United Healthcare did the same thing, started off strong as well, and kind of spiked here and there. Aetna took a decrease from 2011 to 2012 at 16.15, which it dropped because it was at 19.8461. But Humana's doing okay when it comes to giving equity back to the shareholders. Alright, and basically the two companies which I talked about basically the whole time was Bed Bath & Beyond and Humana. This is because comparing and contrasting, if you're looking at the ratios here, show you the ratios at the beginning of the video, and they just blew the competition off the water. They're very liquid. Their leverage is pretty much stable for the most part. Over one, a little over two. Profit margin. Can't complain about profit margin. ROA, of course, and ROE. Nothing but positivity coming out of both of these companies. If I had to choose, based upon the data and the analysis that I was given, I probably have to go with Bed Bath and Beyond, which you kind of wonder if they might be undervalued. But like I said, that was just comparing Bed Bath and Beyond to those four companies. Not pretty. That's not as major. I mean, I compared it to Target and Best Buy, but still, you kind of wonder about these things. They're a lot more liquid than the other companies. I'm not gonna say they're not. They're a lot more liquid than Humana, but as you can tell, when you look at the current ratio and the quick ratio, taking away that inventory, you're not seeing much of a drop from Humana as you did from Bed Bath and Beyond, but I still like Bed Bath and Beyond for the most part. All right, and when I'm projecting the price 1 year ahead, expected earnings times the P ratio. So for Bed Bath and Beyond, I took the EPS expecting the earnings 5.23, multiplied it, and got $55.55. Today's price, as of right now, is $53.42. Their projected dividend is zero. They don't pay dividends. For Humana, what I did was I took EPS again and I multiplied it by the PE ratio. I got $208.60, but today's price is $170.73. So I thought I was off somewhere, which I don't know where. I'm gonna have to look more into it where I was off at. But then I went to the previous year's price, and it actually brought it down to like $143 and some cents. So there has been a spike in Humana. Not sure if there will be another spike, or maybe I just missed some information there. But I did go back and look at the price for Humana going back a year back, and they were priced at about $143 and some change. So it's a possibility it could be a spike. If not, probably just misled some information there. Their projected dividend came out to be about $1.07 for the most part. So basically took the WIC and their dividends, and that's it. Thank you.